Today, we are deep diving into the companies that, well, they define the last decade and are trying to define the next.
The Magnificent Seven. And, we're not just looking at them as stock tickers.
No, not at all.
We're looking at them as ground zero for the largest, most aggressive capital expenditure campaign the world has ever seen. And it's all centered on artificial intelligence.
And that's really the core tension we need to resolve for you today, is this multi-trillion-dollar investment spree.
Right, the synchronized commitment across the biggest companies on the planet.
Is it actually justified by the returns they expect to get? Our sources, particularly an outlook from a financial firm, they paint a very, very clear picture.
And what's that picture?
This is not incremental spending. It's a coordinated, massive platform shift. And we are using hard financial analysis earnings data to really quantify how monumental this physical, real-world build-out truly is.
And the centerpiece of this entire thesis,
Sure.
the company providing the engine for this seismic shift.
It has to be NVIDIA.
It has to be NVIDIA, yeah. We have to start there because the financial narrative can be, well, a little misleading.
It really can.
We've got this critical nugget from the analysis. If you just look at the projected year-over-year earnings growth for NVIDIA, let's say, plus 55% in 2026, followed by what looks like a modest 26.7% in 2027.
It looks like they're hitting a wall. It looks like a sharp deceleration.
Exactly.
And that's what investors who only look at the percentages might conclude. But, and this is crucial, the analysis makes it explicitly clear that this seemingly decelerating growth trend is solely a function of base effect.
Okay, let's make sure you don't miss that. Base effect, what does that mean here in practical terms?
It's everything. Look, think of it this way. If a company starts with, say, $10 in revenue and grows 500%, they're at $60. Sounds huge. But if the next year they grow only 100% to $120, the percentage is lower, but they added more revenue in absolute dollar terms.
So because NVIDIA's base is already astronomical.
Precisely. A 26.7% growth rate in 2027 means they were adding a massive dollar amount on top of an already massive 2026 figure. The underlying demand for their chips, it remains red hot for the next 2 years.
So let's unpack this red-hot demand. What kind of scale are we talking about, like in guaranteed visible dollar revenue right now?
We're talking about truly staggering numbers. The company currently has visibility to $500 billion in Blackwell and Rubin revenue.
500 billion.
$500 billion, just through the end of calendar year 2026.
That level of short-term visibility is almost unheard of in the semiconductor industry. $500 billion in less than 3 years, just for 2 product families.
Exactly, and that just sets the floor. Longer term, NVIDIA believes it will be the superior choice for what's estimated to be a $3 to $4 trillion annual AI infrastructure build by the end of the decade.
And what's driving that kind of projection?
It's 3 things: accelerated computing, these incredibly powerful AI models, and crucially, what they call agentic applications.
Okay, what exactly are agentic applications for our listener?
So, think of an AI that doesn't just answer a question, but actively manages your entire investment portfolio, or schedules your travel, or, diagnoses and manages a complex manufacturing line.
Like self-driving software agents.
Exactly. And they require phenomenal constant compute power. That's what's fueling this demand. It's already showing up in their numbers. Their non-GAAP EPS beat the consensus estimate by almost 5%.
And speaking of performance, what about the tech roadmap? The new Rubin platform is coming. What's the timeline, the performance expectation there?
So the Rubin platform is scheduled to ramp in the second half of 2026, and they are promising an X-factor improvement in performance.
An X-factor improvement.
Right. This relentless exponential leap is exactly what's driving the hyperscalers to spend. They know any current capacity will be eclipsed almost immediately. But crucially, the build-out isn't just the main chip.
It's the whole kitchen sink, not just the stove.
Precisely. You have to look at their networking segment. That's their switches, NVLink, InfiniBand technology.
So the internal highways inside the data center that let all the GPUs talk to each other.
Yes, without bottlenecks. That segment alone generated $8.2 billion in revenue. That's up 162% year over year.
Wow.
That single metric tells you the entire data center is being comprehensively rebuilt from top to bottom.
So with that kind of demand, what about profitability? Are they holding on to those famously high margins?
They're working incredibly hard to hold them stable. The non-GAAP gross margin is projected to be 75% plus or minus 50 basis points.
Okay, hold on. 75% gross margin is an incredible number for hardware. What does 50 basis points mean here?
A basis point is just 1/100th of a percent. So 50 basis points is 0.5%. They're essentially projecting a 75% gross margin with almost no wiggle room.
That's incredible confidence.
It shows immense confidence in their pricing power, yeah. And they are aiming to hold those margins in the mid-70s into fiscal 2027, even with rising input costs.
That is a fascinating detail. And we should briefly mention all this red-hot demand we just discussed. The financial outlook notes that NVIDIA is not assuming any data center compute revenue from China in its Q4 outlook.
Which just underscores the sheer global appetite for this capacity.
Right. Okay, so if NVIDIA's demand is insatiable, we have to look at the customers, the hyperscalers.
The CapEx blitz.
Let's talk about that. Microsoft, Amazon, Alphabet, Meta. How much are they actually spending?
The capital expenditure figures, or CapEx, they are genuinely shocking. It's a fundamental shift. You could call it a synchronized AI infrastructure war.
Start with Microsoft. They have that deep tie-in with OpenAI.
And surprisingly, they are capacity constrained right now. They increased their AI capacity by over 80% this year. They plan to double their data center footprint in the next 2 years.
Double it.
And they actually raised their FY26 CapEx growth rate to be higher than FY25. They reversed earlier guidance. And the reason is simple. Demand for Azure AI services exceeded supply last quarter.
They literally couldn't install the chips fast enough.
Not fast enough. And then there's the commitment from their biggest partner.
Right.
The partnership with OpenAI is incredibly deep. OpenAI has contracted for an incremental $250 billion in Azure services.
Wait, $250 billion? That's not just a big number. That seems to guarantee an ROI on their entire data center build-out.
It provides incredible long-term revenue visibility, yes. It fundamentally underpins Microsoft's huge multi-year spending commitment.
Okay, let's move to Amazon. The source material highlighted a huge impact on their cash position.
This is where you see the true cost of this infrastructure war. Amazon expects full-year cash CapEx of $125 billion in 2025, and that will increase again in 2026.
But the real shockwave was their free cash flow, their FCF.
Exactly. For our listeners, FCF is the cash left over after you pay for everything you need to maintain or expand your business. It's what you can use for buybacks, dividends.
Your war chest.
Your war chest. And Amazon's FCF dropped sharply. It went from $47.7 billion down to $14.8 billion.
That's a drop of about $33 billion.
And that drop was directly attributable to an aggressive $50.9 billion increase in AI infrastructure investments.
So they're essentially betting the house on AI, converting liquid cash into fixed assets at a blistering pace.
That's the perfect analogy. They are accepting a massive short-term cash flow hit because the long-term cost of not securing this capacity would be fatal. And even with this spending, AWS revenue still accelerated to over 20% growth.
So the market is already rewarding them. What about Alphabet? What's Google's commitment look like?
They're right there in the thick of it. They raised their 2025 CapEx guidance to between $91 and $93 billion, and they expect it to increase significantly again in 2026.
Yeah, the payoff.
It's immediate. Their cloud backlog hit $155 billion. That's up 46% in 1 quarter. And revenues from their generative AI models like Gemini grew more than 200% year over year.
Then there's Meta. They seem to be taking the most aggressive, almost ideological approach.
They call it the compute-starved approach.
Yeah.
Their strategy is to, and I'm quoting here, aggressively front-load building capacity. Their CEO said they are perennially operating in a compute-starved state.
So, never enough compute.
Never enough. They believe they can always use more profitably, and they plan for CapEx dollar growth in 2026 to be notably larger than it was in 2025.
What are they getting in return for that right now?
Huge returns. Their AI-powered ad tools have an annual run rate that passed $60 billion. That's direct monetization. And Meta AI, their internal model, has over 1 billion monthly active users.
1 billion. So the capacity they're building is being used immediately.
By billions of people, yes.
So we've covered the core infrastructure war. The scale of that hyperscaler spending is just dizzying. But how does all that compute actually reach you, the consumer?
Right.
Let's shift to the divergent strategies of Apple and Tesla.
The strategies here are really distinct. For Apple, the core business is still the iPhone. That's about half of their revenue. But the services portfolio, App Store, Music, Apple Pay, that's the new engine.
Over 1 billion paid subscribers now.
Over 1 billion, and it's now over a quarter of their total revenues.
So where does AI fit in for Apple? The iPhone is a mature market.
The strategic differentiator is Apple Intelligence. This is the deeply integrated AI suite that will, require new hardware to fully function. This is explicitly expected to boost the iPhone upgrade cycle.
So for Apple, AI is a feature. It's a reason to buy a new phone, and it enhances that super profitable services ecosystem.
Precisely. And then Tesla's approach could not be more different.
Right. They're trying to position themselves as an AI and robotics company that just happens to make cars.
That's exactly it. The CEO explicitly wants the company viewed through that lens. And their biggest bets are, first, FSD and robotaxi.
And how's that going?
The service launched in Austin, expanded to California, Nevada, Arizona. They expect to remove safety drivers in large parts of Austin within a few months. That signals growing confidence.
Even though adoption is still pretty small, what, 12% of the fleet?
It's small, but that public confidence is key to unlocking the software's value. And then you have the massive sci-fi project, Optimus.
The humanoid robot.
Optimus is viewed as potentially being the biggest product of all time. The rationale cited is this potential infinite money glitch from 247 productivity.
Sustainable abundance, as they call it.
That's the goal. The economic potential is just enormous.
And behind all of this is their internal AI hardware push. They're building their own chips.
This vertical integration is key to their whole ambition. The next-gen AI 5 chip is a huge internal focus. It's predicted to be, by some metrics, 40 times better than the previous AI 4 chip.
40 times.
And they're aiming specifically for 2 to 3 times better performance per watt and 10 times better performance per dollar for AI.
Okay, what does that efficiency metric, performance per watt, tell us in practical terms?
It means they get more compute power for the same energy cost. More critically, more compute per square foot of their data center. They are designing the hardware specifically for their software pain points. This relentless pursuit of performance per dollar is how they ensure every dollar they spend on training gets them exponentially closer to viable FSD and Optimus.
That ties back perfectly to a whole CapEx discussion. And, while we're talking about these huge multi-year visions, the market is still processing this day to day. Before we wrap up, I want to interject with a quick, short-term technical perspective from one of the sources. It noted one of the Mag 7 is very close to a breakout and could move quickly once 69.14 is clear.
Right.
It just shows that while the long-term fundamentals are undeniable, the market is still waiting for those technical confirmations.
It's a reminder that the market is a complex machine. Yeah. But if you connect all these pieces, the main takeaway is undeniable. The Mag 7 are not just talking about AI, they're spending massive, massive sums to build the physical foundation for this agentic future.
I mean, when you look at Amazon reducing its free cash flow by over $50 billion just for infrastructure,
Yeah.
you get the sheer magnitude of this shift.
Indeed. And the core risk for you, the investor, or just the observer, is whether the ultimate ROI justifies this unprecedented capital intensity across the entire group. This is the biggest synchronized bet in corporate history.
Which raises a critical final question, doesn't it?
Yeah.
The whole AI bet is meant to drive extreme efficiency, like Tesla's sustainable abundance.
Or massive new revenue, like Microsoft's $250 billion Azure commitment from OpenAI.
Right. But if all these giants are accelerating their CapEx through 2026, all fighting for the same chips and talent, will this aggressive spending lead to a new era of sustainable abundance for the economy? Or will the competitive capacity wars ultimately just lead to prolonged margin compression to low returns for the builders themselves? I think you should definitely track the relationship between their CapEx spend and free cash flow going forward. That will tell you which side of that bet pays off first.
A critical metric to watch for the next 3 years.
That's all the time we have. Thank you for letting us guide you through the source material.